How can it help our trading? How is it important? The trend is your friend. I'm sure you've heard a lot of these different adages. We're going to be talking about all of this and much, much more. We will have a bunch of different slides to share. We're going to use, again, some different kind of contextual sort of textbook like illustrations to help with some of these concepts, to help with the background, etc. for these concepts. We're also going to use some demonstration. We're going to use Active Trader Pro. We might also use fidelity.com if you'd like to follow along. Please feel free to use the Q&A question and answer chat feature at the bottom of your screen. We want to hear from you. We want to hear your questions, concerns, comments. We want to hear it all, and we want to be as helpful and as down to earth as possible with these sessions. So I'm going to go ahead and just finish sharing the disclosures. Again, you can turn on closed captioning. Keep in mind, all of this is for educational purposes. Again, we have no crystal ball. Trend trading is, again, a very important aspect of trading, of investing. It does have its pros, it does have its drawbacks, and we're going to talk about all of that and more. But before we get started, Nick, good afternoon to you. How are you doing, sir? And good to be with you again, back from the morning market briefing this morning today. Okay, I'll give Nick a
So,
couple minutes here.
sorry, yeah. Good to be back with you after this morning market briefing. Yeah, there's so much we can talk about with trend and so much that we can kick off with it. And one of the big things I want to kick off with trend though is, just kind of introduce a little bit of Dow theory. This comes back from, well over 100 years ago with Charles Dow, looking at pricing, looking at the way things are going. This is a little bit more, of course, the Western technical analysis versus Eastern technical analysis. Eastern technical analysis does lean a little more into the candlesticks and such, but Western technical analysis was looking at averages, looking to see how things are moving on average. And that's, of course, where a lot of trend comes from. So with trend traders, one of the big things they're looking to try and do is, maybe they can only catch the middle 60% of the trend. They're not trying to catch the very, very bottom or sell at the very, very top. They're looking to only catch the middle 60% of the trend. And so as such, it's less about maximizing the top and down, so to speak, not with the maximization, but more about trying to reduce portfolio volatility. And because as such with that, if you're missing the bottom 20%, you're missing the top 20%, well, it's going to roll over. You're going to then miss early drops and such, and so you'll maintain a lion's portion of the overall move. But the goal is, of course, get a little bit of that reduction in portfolio volatility. So, with that, there's a lot of different things that traders will look at to help identify trend. But for the most part, and when we're looking at a security that's in an uptrend, you can look at it, you can see what kind of starts in the bottom left, ends in the top right. That's an uptrend. You have prices that are making higher highs and higher lows. Likewise, when a security is moving in a downtrend, it's making lower highs and lower lows and such. And so you have that uptrend, you have that downtrend, but then you also have a trendless environment, so to speak, with that. And so those are really the three big different parts of trend: the uptrend, the downtrend, and the trendless environment. And on the slides we have where it's really kind of bouncing back and forth, a support and resistance level. And one really good example I like to show for this is dealing with the Russell 2000. Back at the back half of 2021, 2022, where it just really moved sideways. The rest of the market was actually having progression. It didn't really have a lot of that movement. We can show this when we shift over to screen share. But trend is also fractal in nature. And one thing you can kind of see even in the upward sloping line is trend goes up, it kind of comes back a little bit, goes up, comes back a little bit. And so with this, if we were to zoom in even more on this, we might see that there's a little bit of a downtrend within the uptrend. and there's even smaller uptrend within the uptrend, and then there's even smaller downtrend within that. So it zooms in and zooms in and zooms in and zooms in, so to speak. And it zooms in so much that while we might be saying that we're currently in an uptrend, then maybe you're looking at a chart of the S&P 500 to say that we're in an uptrend. Well, if you're to zoom out to maybe a longer term chart, looking at it from 2008 to today, well, you might say that's a larger cycle, that we're still in the uptrend from 2008 to now, much less the uptrend from 2021 to now, much less the uptrend from 2020 to now, much less the uptrend just from this morning to now, so to speak. These different time frames of uptrends. Now, there's also, we do have trend indicators and such, and we always get asked whenever I do technical analysis session, whenever I do indicator sessions, which one's the best indicator? And Troy, I know your answer is the same as mine, is that if there's a best indicator, well, in AccuTrader Pro on the charts tab, there would just be the indicator tab versus the indicators tab. We'd only be using the one best one, then that's it. Well, indicators are their tools. They're tools in your toolbox, and they help you identify different things about a chart. And I also like to equate them kind of like a calculator. Are they useful? Absolutely, they're required. Not necessarily. Can you do 2 plus 2 in your head? Sure. Can a calculator tell you what the answer to 2 plus 2 is? Yeah. Likewise, you start to get into, well, what about 4 times 4? I don't know about you, but it's gotten to be where most anytime I do multiplication, I'm pulling up a calculator on my computer now, even though I can still do a lot of that in my head and such. Or you start to do integration, or you do trigonometry and such. Yes, at one point in time, I could do a lot of that in my head, but now I do lean on a calculator to do a lot of that. And well, that's kind of what indicators are helping you with. Is yes, many traders could simply look at a chart like this and go, that's an uptrend. But sometimes having an indicator on the chart can just make it a little bit easier just to confirm with that. Now, when you have a security that's in an uptrend or in a downtrend, one of the things that you'll do is you'll draw trend lines like we've done on this chart, connecting those pivot points, those low pivot points. We have those pivot point low, 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 low. This is then drawing an uptrend line. And this can be important because a security will tend to follow this particular uptrend line until it doesn't, and it breaks the trend line. Traders are then looking to trade within this, and when it's broken that trend line, kind of like with support resistance, when it's broken as support, get now. And you can see that, when it comes back and it tests this trend line each time, it's not testing it at high. What's it doing? It's pulling back to test it. And so it does test it and break it. You can see if you then exited it because it broke the trend line, well, you wouldn't be exiting at the very top. You'd be exiting off the top, so to speak. Also, if you notice that we couldn't create this trend line without having 2 points. So if you drew this and you entered after that second point, is it at the very bottom? No, it's not. So you can kind of see how even then we're getting to it. We're getting to it after it's already set the bottom. We see we have a higher low, so to speak, with that. Now, whether we're trading an uptrend or a downtrend, it's going to be similar. A downtrend, as opposed to connecting those pivot lows, we're going to be connecting the highs, and that's going to be going lower and lower and lower and lower. Keep in mind, though, with downtrends, there is a pretty significant support at 0. Price tends to not go below that. So sometimes when you've seen price swing from very high level to a low level. Troy and I were talking about a security that was at an adjusted 180 not too long ago, now trading less than $5. Well, a move from $5 to 2.5 is like a move from 180 to 90. And so you might also start to look at a logarithmic scale on something like that if it's dropped too significantly. That way you can still draw your trend line, but it's downtrend's the same thing. Connecting those lower peaks, we're seeing a lower high, a lower high, a lower high, a lower high, as it also makes lower lows and such. Now, before we jump into and we talk about trendless environment, anything you might want to add to the discussion so far, Troy?
Yeah, you made a lot of important points, Nick. Trend really is just the interaction of price and time. That's really it when you really think about it. If you want to boil it down and say, bottom line it for me, Troy and Nick, what is trend? Trend is simply the interaction of price and time. And the idea is when we have a downtrending, clear downtrending environment, the price and time are going to be inversely correlated. That means as time goes on, the price goes down. With an uptrend, or as time goes on, the price goes up. So price and time are correlated. Now, there can also be times where we have kind of a hodgepodge mismatch and we have a trendless environment. And this is going to be where we don't have higher highs and higher lows. We might have a very clear support resistance zones. They can also be choppy and be at a bunch of different levels, in which case we might draw some of these zones on a chart. We might place a little bit of maybe more importance on more recent zones, just because price has recently been there. It's kind of part of that recency bias, perhaps. But again, the idea is when you hear, I should say, adages like the trend is your friend, keep in mind trends are very contextual, and you'll hear that technical analysis is fractal in its nature. And what does that mean by fractal? Think of a diamond, right? When you see a diamond, you see its cut, you see how it looks. When you look at it under a microscope, it has those same features in terms of how it reflects, diamond, a crystal, whatever you like to use for that example. So the idea is we can see trends, but we can see them over different time frames. Now, Nick, just like you said, when we're looking at a longer term time frame, a year, 2 years, 5 years, well, let's say we're looking at 1 year and we see a very clear uptrend. Well, if we zoom out to 5 years, perhaps our 1 year uptrend is actually a lower high in a 5 year trend. So I think when we're talking about trend, because we're talking about the interaction of price and time, we need to be clear and we need to be contextual in terms of, are we looking at a short-term trend? Are we looking at a medium term, long term? And we need to keep in mind these phrases, these terms, short term, long term, they are a little bit subjective. If I polled the room here, Nick, and I said, ask every trader here, what's short term to you? Some people might say 5 minutes. Some people might say 5 hours. Some people might say 5 days. That's 1 week. That's pretty short term, right? If I asked the room, what's a long-term trend? Some might say a year. Some might say 5 years. Some might say, I've been riding the same trend for 30 years. That's a long time. So again, when we're talking about short, medium, long term, we need to be kind of clear because short term to me could be different than short term to you and to somebody else. And we need to kind of have some kind of a process to say, all right, I see a short term trend. Does this short-term trend turn into a long-term trend? If I'm following trend and the trend is my friend, has the trend just begun? Is it ending? Am I, have some kind of a certainty that if I identify and I see some kind of a trend, can it potentially continue? And Nick, as you mentioned, that's really where we get is Dow theory, is where we get these assumptions of trading with trend. Of course, there's many strategies to trade against trend. Consider this kind of graphic right here. We could say that from here to here, that was an uptrend. We could say from here to here, that is a clear downtrend. If we say from here to here, well, we'd have to say there's no trend. It went up, then it went down. So again, we have to understand, all right, is there some kind of mechanism? Can we combine trend with other things? Trend by itself is not going to give us the holy grail, the buy sell decision. It's going to be important contextual information that's going to help us understand, okay, if I'm trading against trend, why might I trade against trend? Well, if we were looking at from here to here, and we said, you know what, I'm going to sell to close, or maybe I'm going to short, or I'm going to do some kind of a short trade here. What might my reasoning be? Because we're clearly in an uptrend from here to here. My rationale might be we've been here before and we turned around. I'm anticipating that's going to happen again. So in the near term, I'm actually trading against trend, but I'm combining another technique using something like support and resistance. We might use some other concepts. We're going to focus on trend today, but let me tell you, trend is just one of the main elements of trading. There's trend, there's momentum. There was a question in the chat about volume, support and resistance, volatility, etc. So when we understand all these different elements, they're going to give us a robust view of trading, help us make decisions. None of it's going to be the holy grail, but it's going to help us make decisions and make the best informed decision that we can. Let me pose a question here. So there was this question about volume, and Nick, I'll welcome your thoughts on this. We got a question on volume. Hey, what role does volume play in trend? And I would say if we're purely looking at just trend, volume is really a whole separate category. Because if we pulled up volume on this hypothetical chart, this is a downtrend, right? What if the volume is high here and what if it's low here? What if it's low here, high here? Price is still going down, right? So there are some times where maybe around certain areas, around certain levels, around certain time frames, perhaps around earnings, perhaps around a key announcement, a catalyst, we can see spikes in volume. We can also see at certain levels, perhaps if we looked at this level, hey, we think maybe the trend's changing, it's holding, it bounces up, it turns around. Maybe we see a spike right here because everybody kind of knows at the same time, hey, the trend looks like it's starting to continue. It's been going down. So some of the people betting that it's ending here are making the decision, nope, it looks like it's going to continue. So there could be a lot of decisions being made at a very short period of time. So volume can help us with other things like confirmation. I will say, if we look back, 80, 100 years ago, volume was very important. And I think it still has a role. It still is important, arguably, based on, my simple opinion here. But because trading now involves algorithms, it involves computers, it involves technology, electronic trading, a lot of times the same shares can be traded back and forth multiple times a day. And so what used to tell us that, hey, there's more activity, there's more traders, now it could be, well, there is activity, there is liquidity, which could be helpful. But again, if the same shares go back and forth, back and forth, back and forth, does that really help us with what direction the market's going in? Probably not. So Nick, maybe you want to kind of offer your opinion there on volume. I know it's a separate, we want to stick to trend, but maybe just chime in a little bit there.
So, so as you were saying, we have those three pillars. That's why we call, call today's session kind of the pillar of the trend. You have trend, momentum, volume. And when you have different trading patterns, whether it's head and shoulders, double top, triangles and such, trends, frequently you're looking for volume to be increasing into the pattern. If it's starting to trade in a downtrend, we want volume to be increasing as we keep trading as downtrend. It wants to be increasing as it's uptrending. That if you start to see volume slack off, that could mean that things are about to change. And that's why traders might pay attention to volume, is as it shifts over, as it starts to disagree with trend, that's where you want to look at. And the same thing with momentum and such. And really, one of the fourth pillars now, we'll talk about dealing with volatility. And volatility has really started to replace volume. Why has it started to replace volume? Well, in the last 10, 15, 20 years, it's a lot easier to place trades, a lot easier to place electronic trades. And as such, you have a lot more traders going in and out very frequently. You have that higher frequency trading, and as such that volume isn't paid attention to as much anymore because it's not quite the same, investment volume, so to speak, as it once was 40 years ago. As such as well, if you're trying to calculate standard deviation 40 years ago, wasn't that easy? I had to do everything by hand. And now we have computers that will put up on our chart for you and do it extremely, extremely, extremely quickly for you from that particular perspective. So with that, Troy, why don't we go ahead and jump back into the the conversation du jour. Anything else you wanted to add to that before we start to take a look at some other aspects of trend?
Let's talk real quick, Nick, about some assumptions, right? So people might be saying, okay, the trend is your friend. I get it, Troy, but why does that make sense? Why do we care? Well, going back to Dow theory, trends clearly continue until they don't. And we know that not all trends last forever, last permanently, indefinitely. So there's always the risk that if we look at a trend and we place a trade with the assumption the trend is going to continue, what's the risk there? What's the trade-off? The trade-off could be that could be the end of the trend, right? We could have the very unfortunate luck of placing a trade. Hey, there's a very healthy, uptrend. I'm seeing higher highs and higher lows, and so my assumption is going to be that's going to continue. The risk, of course, is that that doesn't continue, and that's why risk management is so important because we will inevitably be wrong. I've been wrong before, Nick. Nothing against you. I know at some point you've been wrong before. Every trader is going to be wrong at some point. So that's why I like to use the sports analogy of playing defense. But the idea, again, behind going with the trend is sometimes the trend just goes because it goes. And we'll talk, in other sessions, we talk about momentum, which we're not really going to talk too much about today. But sometimes trend just kind of goes and it just kind of continues because it's been going in that direction and it has this sort of this force or this continuing ongoing inertia. And so the idea as a trader, we want a high likelihood of success, right? But that's not the only way we make money. We also have to think about the relative size of our winning trades and the size of our losing trades. And sometimes when trends end, they can end violently and abruptly. And so again, we have to be a little cautious in terms of we want to understand where does the trend clearly start, where does it clearly finish, and how do we distinctly understand, okay, the trend has ended, I should exit. It can be very easy to second guess ourselves, and perhaps we've placed a trade where we thought, okay, the trend looks like it's ending and it dips. Perhaps we're looking at a position on the chart, something like this, only to then suddenly realize, okay, the trend didn't end. This was a bounce and it continues. How do we avoid closing too early and not giving our trade or our trend enough time to continue? So I think that's going to be an important part of our discussion is understanding trend. How do we define trend? How do we be careful not to jump ship too early if we're riding trend? And how do we also be cautious not to be too complacent if we're clearly seeing trend end and we're just doing more damage to ourselves by not managing risk. So those are just some of the thoughts I think that we should keep in mind, Nick, in terms of studying trend. Did we want to do some demo? Do we want to kind of jump into some of the trend indicators? Where do you think we want to go next?
Sure, let me go and steal the screen here. And I have a quick example pulled up, kind of showing trend. And these are of course daily bars. I could drop it down to hourly bars or something like that to really illustrate this as well. But here we have, price kind of starts at the bottom left, ends in the top right. This is an uptrend. Let's kind of zoom out again. What I was zoomed into is this right here. A little bit of a swing up, and we can see from this perspective, yes, this was an uptrend, but really we were in a downtrend. Let's zoom out again. This is this downtrend of this bigger uptrend, so to speak. Let's kind of take a step out again. We can see this bigger uptrend was this. We then had another bigger downtrend with this. And I could have picked even one of these where it really jig, jog, it did even more. With this we can see, I could even zoom out even more. Like I was saying, going from that max perspective here. And, shift this over. We'll go to a logarithmic basis. we can really see on this much longer term basis what is trend doing. And I'm just going to draw these lines right here. Drag this up so it connects. And then we'll just extend this out to the right. We can see we're still bouncing off of these same or similar trend lines. And again, as I said, traders might have been drawing it something like this, where you're below it, you're above it, you're back to it, and such. There's a lot of different ways that you can draw these particular lines, to see where there are these intersections on here. So with that, I do like the idea of addressing and talking about not missing the forest for the trees. And we'll shift over. Let me just pull up a brand new clean chart on here. And I want to pull up and we'll look at the S&P 500. And I'm going to add a couple different indicators to this chart by default. I'm adding in the 20 period moving average, the 50 period moving average, and the 200 period moving average. I'll delete some of these other ones on here that are a lot shorter. I'll delete Bollinger Bands off of here that's kind of showing volatility. And I think this does a really good example of kind of looking at the last 1 year. And we can see what they're showing us. And let me actually shift this over. I remember we were doing a session last week. We kind of demonstrated this. I'm just going to remove these candles like this. Now, based on this, what was price doing during this time frame? Was price going up or down? Well, what we can see with this is we see the shorter term moving average reflecting shorter term trend. Up, down, up, down, up, down, and then now more consistently up during this time frame. Intermediate term, down, up, and then more consistently up. Longer term was down and then up. We can then kind of extrapolate what price was doing during that time based on these indicators. And so to an extent, this kind of goes back to not missing the forest for the trees. That's what indicators can help you do, is to help you see the bigger, broader picture, as opposed to not getting focused too much on a little detail. So let me come back in here. We'll add back in our up and down candles real quick. There we go. Now we have green and red as opposed to just green and green. And you can see that now that we actually look at price, while this intermediate term was up, down, then up, the reality is it's a little more jagged than that. And this is because of these candles we have multiple points of information: an open, a high, a low, and a close. And if we're to do like a line chart, really all a line chart is, it's a 1 period moving average connecting close to close to close to close information. We then lose what the open, high, and low was. It smooths that data out even more for us. And then a 20 period moving average then averages it out. We lose a little bit more data. It smooths it out more for us. But again, it's helping us to see different pieces of information on here. And we can see with this that shorter term down, intermediate term is now down. Now it's back up and such. Down, up, down, up. What about longer term? Well, we can see longer term had been sloping down. And just a little bit of a glimpse on this left-hand side, we can see high, lower high, low, lower low. the potential, if we go back a little bit further, we can see, oh, this was in a little bit longer downtrend, but now it started to recover because now we have it sloping up. So a couple ways these particular trend indicators are used. First is the longer the time frame, the longer it's reflecting. So a 20-period moving average is reflecting a shorter period trend time frame than a 200 period. That's one thing. An additional point is when price is above these indicators, that's typically seen as being a bullish sign. When price is below, it's a bearish sign. So as such, over here, when price is below the 200, traders might say that downward longer term trend, but price is above the 20 and above the 50, intermediate and shorter upward trend. In addition, thirdly, is the slope of these lines. And that's where, when I was hiding the candles, it became a little bit easier to see with that. And maybe if I change these settings just a little bit, we'll change it from candlestick to line. We can then see, based on the slope of these lines, if it's upward sloping, it's an upward trend. If it's downward sloping, it's a downward trend. But keep in mind, of course, even with the 20-period moving average, well, we need 20 price points to have that moving average and such. And therefore, these are lagging indicators and such. The longer the time frame, the longer the lag on here. But they can help you identify where things are going and what they've been doing. As such, anything you might want to add to this particular example, Troy? Because I know this kind of gets a little bit loaded here.
Yeah, again, Nick, there's a lot of ways we can look at trend. And like you mentioned, we don't want to miss the forest for the trees. So there's a bunch of different things we're looking at here, as you mentioned, just to kind of re-summarize. We're looking at the position of the indicators of the individual lines compared to price. Is price above, below, or about the same level? We're also looking at the slope of the indicators. If it's upward sloping, downward sloping, that's also contextual information. And, we'll often get the question that, hey, is there, again, going back to this, is there a best indicator? What's the best moving average value? And we're getting some comments like, hey, what about an exponential? I see you guys don't use exponential a lot. And of course, this is purely stylistic. So I really appreciate the question. Thanks so much for that. But with moving averages, a simple moving average, it has a very plain calculation. It's the arithmetic mean, or add up the numbers, divide by the number of numbers. Exponential is going to weight, it's going to be a weighted average. So it's going to more
Yeah.
weight the more recent data. So it's a little bit more of a complex calculation, but it really does the same thing. And Nick, if you want, with some of the simple moving averages you have on the chart, go ahead and plot an exponential moving average of the same value. You'll notice that they're usually pretty close. They're going to be slightly different because they have a slightly different calculation. However, exponential is going to more heavily weight more recent prices. And there's actually more moving averages out there that will do this to either a more or less extreme extent.
Here's a great example of that, showing that where the simple moving average is a little bit slower to drop than the EMA, because the simple moving average adds up the last 20 periods and they all count equally. So a lot of traders were looking at this and going, well, if something happened 50 periods ago, well, what's going on 50 periods ago is being counted just the same as what happened yesterday. Well, the exponential moving average was created to solve that particular problem. And as such, it formulaically more heavily weights more recent data and such. And so it does tend to drop a little bit quicker. Now, there's trade-offs with everything. And one of the big trade-offs that we talk about is there's a difference between relevance and reliability. With the 20 period versus the 50 period versus the 200 period, there's a trade-off between relevance and reliability. Price crossing the 20 period here, well, it's a lot more relevant than price crossing the 50 period or the 200 period. But those longer term ones are more reliable. Again, the flip side is price crossing the 200 is a lot more reliable, but by the time that happens, it's a lot less relevant. With an exponential moving average, yes, you might get signals just a little bit quicker, but there can be a little bit of a reliability issue with that. And I know studies have been done kind of comparing and contrasting exponential versus simple and which one's better. And really they were inconclusive and such, not showing that one wasn't necessarily better than the other, but many traders simply have a preference for this. Speaking of preference, because again, we always get asked, well, which one do you use? Which one's the best one to use? We have a former colleague named Brian Isabel, and this story of his always sticks out to me that he shared with everyone. And he's been using technical analysis for a long time. I will just say at least 20 years. I know it's been longer than that. But he's been, trading for himself and then teaching clients for a long, long time. And he started with using exponential moving averages and stochastics. That's what he liked the most. He used exponential moving averages and stochastics. Well, after years on the strategy desk, with a lot of clients being familiar with simple moving average because it was a little bit simpler, to grasp the mathematics and to calculate. Since he used a simple moving average more, since he explained it more, he began to understand it more than exponential moving average. As such, he actually shifted from using EMAs to SMAs because that's what he'd been looking at more. That's what he understood more. So that's what becomes important, is not necessarily what I use or what Troy uses or what some other specialist uses. What becomes important is these are trend indicators, they're calculators, they're tools. Which one are you getting better information out of? Which one are you getting better signals out of? Which one do you understand better? That's the one that you should use, when it comes to indicators. And I thought I would just kind of add that in there, Troy, as we kind of show and compare the differences between these two indicators. Anything you might want to add to that?
Yeah, absolutely. I think that's a great, story that style is not better or worse. Again, it's style. Think about sports, think about people who are good at certain things. You'll notice that different people use different approaches and it might work for them better and certain other approaches might work better for others. I think this is a great segue, Nick, with exponential moving averages, there's actually other moving averages as well. We're not going to have time to talk about all of them, but there's going to be things like a whole moving average, a volume weighted moving average. There's going to be 2x, 4x, where it's going to weight 2 times or 4 times the more recent moving averages. And there was a question, hey, can you guys give an example of maybe strategy and how you might use some of this moving average data for strategy? But we'll definitely talk about that in a moment. I will say for all these different moving averages, kind of the take home message, at least this is my perspective here, Nick, is that the ones that are going to more and more start recently or heavily weighting the more recent prices, they're almost to an extent starting to use an element of momentum, right? Because
Yeah.
they're looking at the more recent prices saying, well, the trend has been this, but it's starting to change. And the idea is the trader wants a moving average that's giving you that turn in the moving average faster based on more recent price data. So again, some people might look at that and say, hey, I want to trade a lot of these bends and these moves within the trend. Here's a thought to consider in terms of again, for everything, there's going to be a trade-off. There's not going to be a better or worse. There's going to be some situations this can work, but here in other situations, it's not going to work. I see you have a chart pulled up, Nick. Is there something you wanted to show? Because I got a couple things that I want to just show here.
Yes, I really want to start to dive into some of that trade-off between relevance and reliability. And a semi-recent example, I do like to use this trade-off between relevance and reliability is the COVID drop. And so we can see over here on the left, kind of pre-COVID, interaction with the 20 period and the 50 period, where prices kind of breaking through the 20, breaking the 50, coming up and bouncing. And then over here, we can see it's throughout most of this time frame, it's kind of respecting the 200. But here we have, okay, it breaking the 20, but not the 50. And then finally, here, it broke the 20 and the 50. So the way many traders will utilize these moving averages is if you're just using the 20, it breaks 20, you get out, it comes back up above the 20, you get back in. It breaks 20, you get out, comes back above the 20, you get back in. You're in and out. Or maybe you're long or short. Or they might go, it breaks the 50, you're out. It comes back up into it, you're back in. Breaks the 50, you're out. Comes back into it, you're back in. Or they might say the 200. And so this is a pretty good example of kind of showing when those time frames might have happened. That trade-off between relevance and reliability. Price breaking the 200, a lot more reliable than price breaking the 20, price breaking the 50. You're not getting whipsawed as much, as you can see with this, where here, whipsaw, 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 whipsaw on the 20, or just only one whipsaw on the 50. But look how much further it had to drop before it crossed the 200. So this trade-off between relevance and reliability. Something else traders might do is, as opposed to just price cross the moving average, they might say moving averages cross each other. A faster crosses a slow. I had a 5 period up here. They might look at the 5 crossing something, or another big one is the 20 crossing the 50, or the 50 crossing the 200. Being a golden or death crosses, you the 50 and the 200 crossing. And so here we have the 20 crossing below the 50, might have gotten out and then gotten back in and then stayed in and then gotten out again over here. Let me draw the horizontal line right here, showing where the 20 crossed below the 50 would have gotten out over here. A little bit more reliable than just price crossing the 20 or price crossing the 50, moving average crossovers. But again, a little less relevant compared to when the price actually happened. Now, let's then explore the golden cross, the death cross you hear about on TV. That's when the 50 crossed the 200 period moving average. Now, when did we have the death cross due to COVID? Right here. Here's where we had a death cross right here. Where was price? We'll drag this over real quick. Here's where price was. We can see by the time the 50 crossed below the 200, honestly, price has already bottomed out and started to recover a little bit. So you'd have gotten out way down here by the time that happened. What about in the recovery process? You'd have gotten back in way over here. We've really almost already back to pre-COVID levels by the time you got back in. You can see a lot of lag here on this 50 crossing the 200. A lot more reliable. Yeah, we're in a downtrend, but a lot less relevant by the time this happened. And that's that trade-off. And I think this also segues to, and it provides a good example of looking to catch the middle of a trend. So let's look at this right here. The 2020 upward move, 2021 upward move of this. So let's say you were just looking at price crossing moving averages. And let's say you were looking at a little bit of a longer term. You're looking at the 200 period moving average. Well, when would you have gotten in? When would you have gotten out? We likely would have gotten in right about here. Gotten out right about there. So you can see and talk about the middle of 60% of the trend. Well, you're not getting at the very bottom here. It's made a recovery before you've gotten in, and it's price crossed above the 200, kind of went back down below. Finally, it's really stayed up above it, really about the same level. Say the same thing over here, dropped below the 200, came back up. You really would have gotten at about the same level. You've missed the bottom 20% of the trend, ridden this up, missed the top 20%, but caught this middle. Now, again, like I mentioned before, a simple buy and hold strategy, maybe you'd slightly outperform having trend traded like this. But what would the big difference have been? When price dropped right here, yeah, you didn't make any additional money by buying it lower, but what happened? You got out and you didn't see portfolio volatility drop like this. Let's zoom back out again. And what do we have? We got out here. And you would have been out during a good chunk of this in 2022 and then gotten back in. And yes, you'd have gotten in a little bit lower than been in here. You're reducing portfolio volatility with this. And so to an extent, while you might not have better raw percentage returns, a lot of traders look to then have better risk adjusted returns or returns per unit of volatility that their portfolio is exposed to. With that, Troy, anything that you might want to add to this before maybe we take a look at some other types of trend indicators?
Yeah, I think I just want to, if I can, Nick, just piggyback on this concept of that you mentioned about the meat of the trend or the middle of the trend. I think this is really so important to studying trend. I'm going to grab the screen just for a moment here. I know we've, getting a little short on time, have about just under 15 minutes or so, but we did get a request to look at Google or Alphabet. And I think this really emphasizes the point that you were making, Nick, is if we look at here's a 5-year chart of Google, we can see it was in a strong downtrend for a while. There's a ton of volatility, ups and downs, and then eventually we have an uptrend. Now, from a trend trading perspective, a trend trader ideally is going to, and again, there's a stylistic element here, folks, so keep that in mind. But typically, a trend trader is going to say to themselves, I'm interested in this part. I'm not interested in this part. I'm not interested in this part. We want to try to get the meat, the middle of the trend, because that's where typically we start to see the most of the trend, the most movement, right? If we look at, this is a 5-year or so chart of Google zoomed in. If we look at the last 2 years, it's been pretty consistent. It's been pretty heavily trending. Now, if we use some indicators, again, we can use, short, medium, long term. I'll be honest, I don't like too many moving averages. Again, this is a stylistic thing, Nick, and for those watching out there, I don't like too many moving averages because then it starts to me look a little bit like spaghetti where I've got just lines going everywhere and it can be really, really, confusing. But what I will say, what moving averages can help us do, there was a question that, hey, what would be a way to spot a reversal or what would be an example of a good entry point? For example, one of the things you will start to see, and this is going to be, doesn't matter what really indicators you use, if you use some kind of short-term indicator, and this could be a 5, a 10, a 20, a 25, I would say once you get to start to be around the 50 area, that starts to be in the middle, in terms of the midterm aspect of trend. And again, that's stylistic, that's preference based. There can be 100 SMA. These are just popular round numbers. And then long term around 100 to 200, I think that starts to be a little bit arguably of a longer term trend. But what you will start to see is you'll start to see a lot of traffic with moving averages. And actually, in our slides that these are also going to be found if you're in the technical analysis class, you'll see this is when you start to see reversals of a very strong trend, you start to see a lot of crossovers. A lot of the short term, the medium term, the long term, they're all going to start to interact and they're all going to start saying something is changing. And Nick, like you pointed out, because they're averages and they're based on past average prices, they're going to be lagging. So there's a little bit of responsibility on the part of the trader to say which indicator are you going to watch, which level are you going to watch. Do you want to put an extra volatility filter on it where you'll say, all right, I want to let 2% lower than this price just to give it a little bit of wiggle room in case there's some kind of a volatility bounce. But you'll see towards the end of a trend, you start to see a lot of clusters. This was the start of a little bit of a downtrend. There was more clusters. And then what do you see in the right-hand part of this chart? You see nice, steady, even trend. Often that's the area where we want to trade in. That's where we want to start to gain or at least look for an entry point. So if you're looking at a perfect world for example, Google, well, right around here is probably almost a perfect spot where you have, and you could even, you could even have waited a little bit longer. You could have had, once it bounced here at the 20, you could do here. You could have added once it bounced here. There's a lot of there's no necessarily perfect area, but the idea is you want some kind of concept of trend. And again, we can use moving averages. We can use things like lines. This is a breakout right here. This
Hmm.
is an area where price is bouncing above where it's been in terms of the recent highs. And this was kind of the starting point. Now, again, there was a lot of volatility. Google has kind of done this in terms of its uniqueness, in terms of bouncing around here. So there was a lot of areas that really tested our patience and tested our ability. Did we want to use a longer term aspect like the 200? It did interact for a while. So again, we don't know it's going to bounce. So we have to ideally have some kind of metric that's going to help us understand. And we have to know that not every trend is so perfect and is so neat and organized. Oftentimes, there can be tons of volatility in trend. I wanted to answer one more other question, Nick. Then we can finish with kind of showing all the different aspects of different indicators here. There also was a request to look at Chart Plus with NVIDIA, and folks, there's a lot of different indicators out there in Active Trader Pro. There's a couple unique ones within Chart Plus. So if we go to indicators, you'll see a whole list here. There was a question here about a specific indicator called, for example, super trend. You'll see here with all these indicators, they have this little eye, if you see that, where if you go ahead and click on that, it's going to give you a more detailed explanation of what the indicator does, how it's calculated. And again, some of these you have to kind of understand what it's trying to do and its merits and drawbacks. For example, if I just throw this on here, this is basically a tool where it's visualizing the idea of like a stop loss. You could see here, if we go down and we zoom out a little bit here, during times of a strong uptrend, this could be a good way to stay with a trend. NVIDIA was a very strong trending name, and you can see here there was a lot of green to be made. Now, when would this indicator or this process not have worked? Well, it would not have worked in a trendless environment or a sideways environment where if you use the idea of just levels of stops and entry points, it's going to end up chopping up your shares. You're out here, you're in here, you're out, you're in, you're out, you're in, you're out. You're not really making money. So the idea is we kind of need to have some type of strong trend in place. And then the idea of sticking with trend, adding on dips or being cautious during dips if you're already long is going to be a little bit more of a helpful aspect to you. But again, there's so many different indicators in terms of moving average clusters. There's one that will, I think it's called, there's many different ones, but there's one called, I think it's called Rainbow. Let's take a look here. Random walk, maybe it's called something different, but There's one where it'll add a bunch of different moving averages and different time segments. And again, if you're looking for the clusters, the crossovers, sometimes that can be helpful to kind of understand, again, when a lot of these indicators are moving, when they could be signaling that you're at a local top or a local bottom. Also, you can just, some people will start by first looking at a bear chart, doing some analysis there, and then maybe adding on some indicators as well. But Nick, there's so many different indicators. Perhaps we want to talk about the technical indicator guide and how we can look at all these resources and make sure we understand what the indicator is, how it's calculated, and what it's really trying to do for us.
Absolutely. Now, one other indicator I'd like to show from a trend perspective, and we can do this either on Chart Plus or AccuTrader Pro, is ADX is something we get asked about, the average directional index. Now, there's other aspects of this when you are looking at the technical indicator. There's the DMI plus and DMI minus and such. And just real quick for us, could you please remove the plus and the minus from that chart? And now what I want you to do is add in a horizontal line at 25. So what ADX is then showing us is, in essence, it's asking, are we in a trend or not? And if we're less than 20, we're considered to not be in a trending environment. If we're over 25, we're considered to be in a trending environment. But notice that I didn't say uptrend versus downtrend, just in a trending environment. And we can see that May 2023, it spikes up above that. It's now saying that we're in a trending environment. And we can look at price, and we can see it's higher highs, and we can then assume this is in an uptrend environment that we are. Look at the far left-hand side of the chart, we see that spike up in November 2022, but we see price then made another lower low. We'll get it showing that we were in a trending environment, but at that time it was a downtrend. And so I want to bring up this tool simply because it's showing us that, is there a trend or not on this? And Troy, if you could shift this back over to, well, let's look at Russell real quick, and I want to take a look at the 2021 timeframe of Russell. So look at the last 5 years, and we'll look back over there. We can see when Russell was just kind of going sideways. What was ADX doing? Well, ADX, you see, it was pretty high on the left-hand side because, well, price had gone up into this particular pattern quite heavily, but then during this entire time frame, ADX is doing nothing, showing that we're in a trendless environment. Now, looking at the left-hand side, we can see that we were trending and then are no longer trending. And as Troy kind of scrolled over, we can see that, well, that was, visually look at, we can see price went from the bottom at the upper right, we're in an upward trend. And as Troy then takes us the other way, we can see when ADX more recently went up above 25 after having gone sideways. So if you could drag us back to the other side, Troy, as well. When ADX went back up above it again, well, what was price doing? Kind of upper left, bottom. We're now starting to trend, but trending down on here. So this I want to point out is this is a trend indicator. It isn't really explaining direction. Now, I did have Troy, of course, remove the DMI plus and DMI minus because that starts to get into, well, what direction is trend in? But I think this is just having ADX is a useful tool for demonstrating, are we in a trend or not? Now, Troy, I know you're adding a couple horizontal lines for illustration. Did you want to kind of address some of those as we wrap up?
Yeah, Nick, again, just illustrating what you already pointed on, if we're looking at the crossover of the 25th level, we can use, again, some horizontal lines. Sometimes that can, again, aesthetically be a little bit of maybe an assistance there, just so we can see, for example, if we look at where it was above distinctly 25, and again, I'm just going to finish drawing some lines here, and then I'm going to zoom in, you could see we're in a pretty clear trending environment. And again, it's not telling us it's going up or down. It's just saying, hey, there's concepts of trend that are there. And so, we could trade when this is above that, we could seek opportunities to say, okay, we have to first determine is it an uptrend, is it a downtrend? And then we could potentially seek trend trading opportunities. This is a daily chart, and this starts here around, call it mid-November 2020. And this ends here around February, the end of February of 2021. So this gave us about, call it about 3.5 months in terms of, within a trend. There were a couple dips here. It's not a straight line. But if you're asking yourself, what environment do I want to trade? What context of trend? There's so many indicators that can be out there that can help you with your trading. The simple indicator just like this could have said, okay, during this time frame, seek trend following opportunities. And then, for example, when we went sideways, well, this indicator was clearly above 25. So if we sought trend trading opportunities, well, maybe we can make a buck or two here or there, but there's a lot of chop. And likely if we tried to go long here and then closed here, we maybe tried to go long again here, and it would have just not worked out. So again, that's kind of the indicator. That's how it's meant to be used. So whenever we're using a new indicator, we have to understand what are its capabilities, what is it trying to do. I love the analogy you used towards the beginning, Nick, and this is very applicable to myself, my degree, my background's in math. And you mentioned, Nick, hey, there's all these different calculators out there. A standard calculator, an advanced calculator, whether it's a scientific or a graphing calculator, they can do more things. But the idea is is that going to help you get a higher test score? And the answer is no. I had a fancy calculator and I was a good student. I know there were some great students that had a very simple calculator and they did the more complex work by hand. They showed their work. There were some that were not great students and they got very fancy calculators. And if they didn't know how to use them and the calculators didn't give them the answer to the test, right? The skill involved was using the calculator to help you solve the question. And so the idea is, are these indicators, are they helpful tools to help you make a trading decision? If you often find that you're hitting yourself, on the head thinking, I'm not even seeing trend. How are you doing this? Take a step back, make sure you're using an indicator that's helping you for your strategy. And again, trend trading is about, we're not talking about the beginning, we're not talking about the end, we're more concerned about the middle because that's where the trend trading opportunity is. Towards the beginning, there's a lot of volatility because the trend is starting. Towards the end, we tend to see a lot of volatility because the trend is ending. The analogy I like to use is surfing a wave, right? Think about, we don't predict where a wave is going to start or where it's going to finish. We wait till it's formed, we try to ride some of it, and then we try to glide off nicely before it crashes. So trend trading is much the same way. And the idea is, again, trend is not the only thing we're going to look for. We're going to understand things like volatility. Volume can be helpful in a number of different, instances. We're going to understand momentum or strength of trend. So now that we're wrapping up, and I know, Nick, we're already at time, I would encourage all of you out there, if you got something out of this trend discussion, let us know. And I would say be on the lookout for some of these other pillar classes we have. We have recurring monthly class on technical analysis. On the third week, if you choose to join us, we'll talk a little bit about all the different classes because every indicator is going to be really in a distinct class. It's going to be usually a trend indicator, a momentum indicator. There are some hybrids. So there is going to be some indicators that are doing a little bit of both. But the idea is, how does trend relate to things like momentum? Is the trend strong? Is the trend potentially waning? A trend can still be there and it can still be weakening. And oftentimes, a strong trend can be weakening, but it'll still go on for some time. So that might be something that tells us, hey, you're riding this wave, but it's starting to arc a little bit. So you might want to get off at some point. And I think that's going to be helpful for a lot of traders. I'm going to end, Nick, here by going up here if you haven't before, go to the news and research tab. The very bottom where it says learn, you'll not only see our sessions, you'll see a lot of useful information. On the left-hand side here, you can go to events. This is where you can attend some of our other sessions. I would encourage you to check out our technical analysis class. There was a question, hey, do you guys do more things on the stock screener to find and narrow down more stocks? Absolutely. We do tons of sessions on the stock screener. But also under topics, there's a lot of interesting information that can be helpful for you. If you go to topics, advanced trading, there's a technical indicator guide. Full disclosure, it's not going to have every single technical indicator out there. You can use a Google search. If there's some, for example, that are new that are in the Chart Plus or Trade Dashboard feature, there's often going to be that little eye that I showed you that's circled that could tell you a little bit about it. But make sure, okay, if you're looking for a trend indicator, you can go to this tool and say, all right, just show me trend indicators. And it's going to narrow it down for you, but you're going to get a lot of different indicators. These are all indicators that have something to do with trend. And you'll see some of them are blended indicators. We do a session occasionally on Ichimoku clouds, and this is a trading system that incorporates multiple elements of technical analysis, such as momentum, support and resistance, and trend. Versus if you look at ADX, which we were just showing, this is mostly a trend trading indicator. There's also the D minus, D plus, that can help you understand kind of contextual information, contextual concepts of trend. But again, there's also things like MACD. I use that a lot if you attend, briefing sessions. Again, it's not the best indicator because it's not bounded. And so there's certain things it can do. There's certain things it can't do that perhaps RSI or some other indicators might be better at telling you. But the idea is understand your tool, make sure the tool is helpful for you placing a trade. And again, there's no golden ticket. If there was, we would let you know. Or maybe if there was a special indicator out there, everybody would use it. And we know that markets wouldn't be efficient that way if everybody's trading the same way. It takes both a buyer and a seller to make a market. But Nick, if there's any other final comments or maybe questions that stood out to you, I think we should end it here. And just want to encourage everybody to review what we've discussed. Don't go too much into it. Take small steps and encourage others to attend the sessions where we have other things like momentum, volatility that build upon these concepts of trend.
I think that's really a good place to end it, Troy. Last thing I do, of course, want to mention is I want to thank you for joining us, for spending an hour of your time with us. Hopefully you found this to be a good investment of your time. We do, of course, want to welcome everyone back to our after market session. We're going to be kicking off in about 20 minutes. In a lot of our briefing sessions, we do, of course, analyze and use things like trend to take a look at price movements throughout the day and such. Again, thank you for joining us, everyone, and please come back for some of our future sessions. Take care.